Why do so many of us struggle financially despite following the well-worn advice handed down through generations? Have you ever wondered why, despite the countless financial books and seminars, a staggering 64% of Americans can't cover a $1,000 emergency expense? Or why nearly half of working-age Americans have no retirement savings at all? These numbers paint a sobering picture, don't they? It seems like everyone knows they should save, invest, and avoid debt, yet the reality is far more complex. The shocking truth is that traditional financial education has failed many of us, leaving us ill-prepared for real-world financial challenges. You see, the typical advice, live below your means, save for a rainy day, and invest in a diversified portfolio, oversimplifies our relationship with money and often overlooks critical psychological and practical elements that can make or break our financial journeys. Stick with me as we unpack 10 common yet flawed pieces of traditional financial advice, revealing why they often lead us astray and offering practical alternatives that can genuinely empower you on your path to wealth building and financial freedom. By the end of this discussion, you'll understand why conventional money discourse might have set you up for failure, and how to turn that around with smarter, more actionable strategies. So if you're ready to reshape your financial destiny and reclaim your wealth-building power, let's dive into the heart of the matter. Many of us have grown up hearing that we should simply avoid debt. Debt is bad, we hear repeatedly. However, this narrow view fails to account for the fact that not all debt is created equal. For instance, think about student loans. Yes, carrying debt can be burdensome, but what if that education opens doors to a career with a six-figure salary? It's estimated that a bachelor's degree can boost lifetime earnings by nearly $1 million. Meanwhile, a mortgage on a property can be a smart move if it allows you to build equity over time. The problem arises when we don't differentiate between good and bad debt. Many people will shy away from loans, missing out on valuable investments that could yield future returns. The truth is, leveraging debt appropriately can actually magnify wealth creation opportunities. So instead of taking a blanket approach to all debt, ask yourself, is this debt helping me build toward a greater financial goal? To implement this, consider creating a debt management strategy. Categorize your debts into good and bad, and focus on prioritizing the bad debts first, while utilizing good debts as a stepping stone for growth. This nuanced understanding will not only improve your financial health, but can also lead to better investment decisions down the line. Another piece of traditional advice that often leads people astray is the practice of living frugally and cutting down expenses at all costs. While saving money is undoubtedly important, this extremity can sometimes lead to scarcity mindsets and reduced quality of life. A Harvard Business Review study shows that focusing excessively on frugality can inadvertently result in missed opportunities for wealth creation. For instance, what if instead of cutting out that monthly coffee shop visit, you focused on generating additional income through side hustles? A simple gig, like freelancing or renting out a room on Airbnb, could triple your income potential. The truth is, smart investing in your personal development or new ventures can yield far greater financial returns than mere penny pinching. To move forward, you can set income goals rather than solely focusing on reducing expenses. Explore online platforms where you can monetize your skills or hobbies, and allocate a percentage to skill-enhancing courses instead of eliminating small indulgences. This shift in mindset opens doors not only to enrichment and fulfillment, but also to increased wealth-building opportunities in the long run. Now let's talk about the notion of saving a fixed percentage of your income. The classic recommendation often suggests saving 10 to 20% of your income for future security. Research from the Economic Policy Institute reveals that just over 1 in 5 Americans save less than 5% of their income at present. This statistic indicates that while the advice to save is well-intentioned, many individuals feel overwhelmed and incapable of adhering to it. Instead of discounting other priorities, consider a more flexible approach. Implement the 50-30-20 rule. Allocate 50% for needs, 30% for wants, and 20% for savings. However, if saving 20% feels unrealistic, start with what you can afford, perhaps 5%, and gradually increase that amount as your financial situation improves. The key here is to make saving a habit rather than a number, allowing you to build wealth over time without sacrificing your current quality of life. As we move onward, let's examine the glorified concept of buying low and selling high in the stock market. This simplistic explanation of investing can lead to anxiety and irrational decision-making. The Boglehead's investment philosophy teaches us that timing the market can often lead to poor investment outcomes. Behavioral phenomena like loss aversion can affect investors' decisions, resulting in them missing out on gains during bull markets. If you've ever sold off your stocks in a panic at a market downturn, you aren't alone. Instead of concerning yourself with illicit market timing, adopting a buy and hold strategy can be far more advantageous. Research consistently shows that long-term investments yield better returns than trying to predict market fluctuations. For actionable steps, consider starting with a diversified index fund or a target date fund that aligns with your retirement and long-term financial goals. Setting up automatic contributions to an investment account can help you circumvent the temptation to react emotionally to market changes. This way, you'll be cultivating patience and discipline in your investment practice, ultimately leading you closer to your financial goals. Let's pause here for a quick reminder of what's to come. The next few tips are going to flip your understanding of financial education on its head. No more robotic adherence to outdated maxims. We'll reveal why many believe planning for retirement is a 30-year project, when, in fact, smart financial decisions can be made now to set you up for success. Are you ready to redefine what you thought you knew about money and wealth? Hang tight as we delve into the often overlooked approach to building wealth through proactive financial behaviors over a lifetime. Continuing on, we turn our attention to the advice of putting money in a savings account. Sure, having an emergency fund is crucial. It's often touted as your safety net during difficult times. However, standard savings accounts yield a minuscule interest rate, sometimes as low as 0.05%, which doesn't keep pace with inflation. The reality is that keeping your hard-earned money in a low-yield savings account can cost you in purchasing power over time. Instead, consider adopting a balanced savings strategy where you hold a portion in a high-yield savings account for emergencies while strategically investing the rest in stocks, bonds, or other appreciating assets. Studies show that historically, the stock market returns about 7% annually, adjusted for inflation. Building wealth over time requires savvy versus stagnant approaches. For implementation, determine what 3 to 6 months' worth of expenses look like for you and set that aside in an easily accessible account. Then, identify long-term investment vehicles like a Roth IRA or employer-sponsored retirement plans where you can channel excess funds for growth. This approach provides you peace of mind while leveraging the power of compound interest, an essential tool for wealth acceleration. Next on our agenda is the notion of prioritizing financial literacy over financial action. Yes, understanding financial principles is essential, but there's another crucial part of the equation: execution. A report by the National Endowment for Financial Education found that even educated individuals struggle to apply their knowledge. Information alone does not translate to action. Someone may read every book on investing, but fail to execute simple portfolio strategies due to fear or overanalysis paralysis. Therefore, it's crucial to move from learning to doing. Think about starting small. If you want to invest, buy a fraction of a share in a company that interests you, or enroll in a low-risk investment fund. The key is to get your foot in the door, build confidence in your choices, and gain the experience necessary to make informed decisions. To help with this, outline financial action steps that are smart, specific, measurable, achievable, relevant, and time-sensitive. This will guide you from contemplation to tangible growth and reinforce the habit of taking action toward your financial goals. You might also have heard that being rich means having a high income, but let's debunk that myth right now. Many high earners find themselves trapped in patterns of consumerism and lifestyle inflation. In fact, a study by the National Bureau of Economic Research revealed that those with higher incomes often save less than their lower income counterparts due to increased lifestyles. So instead of solely chasing the next promotion or raise, why not focus on wealth building rather than income building? Wealth is built over time through smart asset management. Consider implementing strategies such as passive income streams or rental properties. This approach leads not only to money, but also financial autonomy, what wealth truly represents. Instead of living paycheck to paycheck, sit down and analyze your assets and liabilities. How can you turn an existing resource into a source of passive income? Real estate may be a learning curve, but starting small with rental properties or house hacking can yield substantial returns over time. Look for local resources to assist you in understanding the rental market to ensure that your entrance into property investment is not only viable but profitable. Finally, let's explore the ingrained belief that money is inherently evil or corrupting. This perspective can't be further from the truth. Money is merely a tool. It's what we do with it that defines its value. Countless philanthropic ventures stem from powerful wealth, and many successful entrepreneurs use their financial acumen to create opportunities for others. It's imperative to shift the perception from viewing money as a necessary evil to understanding it as a means of agency and empowerment. Commit to redefining your relationship with money by investing not only in your financial knowledge, but also in your community and projects that create positive change. Consider allocating a portion of your financial growth to causes you care about, because money, when paired with intention, can lead to transformative outcomes for you and others. As a step toward this transformative view, practice being intentional in your spending habits. Align your financial goals with your values, and find ways to support businesses, charities, and projects that mirror your aspirations. This mindset not only fosters a healthy relationship with money, but it also creates ripple effects of potential abundance. As we wrap up, it is clear that traditional financial advice, while well-loved, often trips us up. Instead of wandering aimlessly through outdated practices, remember to question what you learn. Tailor your approach to your unique situation and implement actionable strategies that align with your values. Whether it's wisely leveraging debt, rethinking frugality, embracing smart investing, or redefining your relationship with money, the 10 strategies we've unpacked here tonight offer you the opportunity to succeed. Take immediate steps to apply at least one of these insights today and watch the positive changes on the horizon. If you found value in this discussion, like, subscribe, and share your thoughts below. Together, let's transform our understanding of wealth into practical steps that launch us into our financial futures. Your journey to financial empowerment starts now, so take action and commit to rewriting your financial narrative.